While most people were raising a glass and counting down the final seconds of the year, I was staring at something far more revealing than fireworks. On my trading terminal at exactly 9:30 p.m. Eastern on December 31st, the silver market didn't simply close the year. It was violently shut down. In over a decade of watching metals trade through crises rallies and quiet holiday sessions, I have rarely seen a move this sudden, this aggressive, and this perfectly timed. What unfolded in that final hour wasn't random, and it certainly wasn't retail traders taking profits before midnight. It was institutional force applied with urgency. I'm a private commodities analyst. I've spent years trading metals, tracking liquidity flows, and accumulating physical silver long before it became fashionable to talk about it again. I built this channel because I got tired of watching mainstream narratives arrive hours, sometimes days, after the real story had already played out. And lately, with AI-generated hype channels recycling the same tired, bullish slogans, it's become harder than ever to separate signal from noise. So, let me be clear from the start. This isn't about hype, it's about data timing and incentives. Silver closed at 71.39, down more than 5% in the final stretch of what was supposed to be a quiet, low-volume holiday session. At the same time, almost to the minute, the Federal Reserve injected $31 billion into the overnight repo market. That number matters. It was the largest single injection since the chaos of March 2020 when global markets were in freefall. Tomorrow's headlines will celebrate silver's incredible year up triple digits. And technically they won't be wrong. But they won't talk about the violence of that last hour, or why silver was brutally rejected just below recent highs. This chapter is about setting the frame. What you're seeing on your screen is not the whole market, it's a carefully managed surface. Beneath it, something broke and someone needed time before regulators took their year-end snapshot. If that sounds dramatic, good. It should, because what happened last night wasn't the end of a story. It was the cover-up of one. If you want to understand what really drives price liquidity and power in financial markets, make sure you're subscribed to the channel and leave a comment, with the number 1 if you're following this closely, or 2 if this is the first time you've heard this perspective. Your engagement helps this analysis reach people who are tired of recycled narratives. To understand why that final hour mattered so much, you have to look past the headline numbers and focus on behavior. Markets speak through action, not excuses, and the action in silver that night was anything but normal. Before the collapse, silver briefly touched levels that hadn't been seen in decades. The move was sharp, confident, and backed by momentum that had been building for months. Then without warning, it was slammed lower in a near-vertical drop. That is not how healthy markets reverse. That is how positions are terminated. When I look at a chart like that, I'm not asking whether silver was overbought or whether traders wanted to lock in gains. I'm asking who was forced to act and why the timing was so precise. The candle tells the story. A small body with a long upper wick, what technicians call a shooting star. Price pushed higher, met overwhelming resistance, and was driven back down with force. That kind of rejection doesn't come from thousands of small traders clicking sell. It comes from size, from urgency, from someone who cannot wait for a better price. At the same time silver was collapsing, gold barely moved. That divergence matters. In periods of broad risk-off behavior, precious metals tend to move together. But here gold was calm, while silver was destroyed. That tells me this wasn't a macro decision about metals as a whole. It was targeted. Something specific to silver broke, and it broke fast. Now add what was happening away from the screens. I was getting messages from the dealers and contacts across multiple regions saying the same thing in different words. Physical silver was not trading anywhere near the quoted price. Premiums were exploding. Supply was tight. Transactions were happening at levels that made the paper price look almost fictional. When you hear that story once, you stay skeptical. When you hear it from different continents within hours, you pay attention. So ask yourself a simple question. If you cannot actually buy the asset at the quoted price, what does that price represent? Is it a market, or is it a reference number maintained for convenience and control? That question sits at the center of everything that follows, because once price divorces from reality, the system becomes fragile. And fragile systems don't break slowly. They break all at once, usually at the worst possible moment. The speed of the drop is what removes any remaining ambiguity. Genuine profit-taking has structure. Large players unwind positions gradually to minimize slippage and avoid signaling stress. What happened in silver had none of those characteristics. It was sudden, concentrated, and indifferent to price. That behavior only appears when selling is not optional. This was forced liquidation. The timing confirms it. This did not occur on a random trading day. It happened in the final hour of the final day of the fiscal year. At midnight, banks face a regulatory snapshot of their balance sheets. Capital ratios, leverage, and risk exposure are frozen and reported. If a position looks catastrophic at that exact moment, waiting is not an option. You either neutralize the exposure or fail the inspection. This is where year-end window dressing becomes critical. Every large institution understands this process. It's not about solving problems. It's about delaying them. Positions that look dangerous are temporarily neutralized, losses are compressed, and liquidity is sourced to make the numbers passable for one specific moment in time. Once the clock rolls over, the real damage can be dealt with later. Think of it as controlled concealment. When there isn't enough time to fix the mess, it gets hidden. Silver became that mess. The market absorbed the shock, and something large disappeared from view just long enough to make the books look stable. But liquidation alone doesn't close the loop. Selling creates settlement obligations. Cash must be delivered. Margins must be met. And that's where the second half of this event matters. While silver was being driven lower, liquidity was injected elsewhere in the system rapidly and at scale. When price action and emergency liquidity appear together, they stop being coincidences. They become evidence of necessity. The liquidity injection is the detail most people overlook, but it's the one that changes the entire interpretation. Labels don't matter here. Size and timing do. $31 billion does not move through overnight funding markets without pressure behind it, especially not in the final hours of the year. Look at when interventions of this scale usually occur. They show up during moments when financial plumbing stops functioning smoothly, not during calm conditions. The purpose isn't to support prices or send signals. It's to prevent a breakdown from spreading. One institution under stress can quickly become a systemic problem if it cannot meet short-term obligations. Now line up the sequence as silver surges, then collapses violently. A large position is forced out. Immediately after, massive liquidity appears through the repo facility. Repos exist for one reason: to provide immediate cash to institutions that need it now. When they are used at this magnitude, someone is facing a funding shortfall that cannot wait. Large silver positions are not trivial exposures. They involve enormous leverage and tight margin requirements. A sharp adverse move doesn't create discomfort, it creates insolvency risk. When that happens, at year-end, survival becomes the only objective. Calling this routine misses the point. Routine actions don't coincide with emergency price behavior. When both appear together, the simplest explanation is stress management. Something had to be stabilized before the books were frozen. And when markets are forced to serve that purpose, natural price discovery disappears. Once you accept that this was a survival maneuver, the rest of the puzzle starts to align. The market behavior that followed wasn't about confidence returning or traders reassessing value. It was about control. After the liquidation, volume dried up almost instantly. That kind of silence doesn't happen in a healthy correction. It happens when participants step back, unsure whether the price they're seeing is real or simply being maintained. This is where the gap between paper and physical becomes impossible to ignore. On exchanges, silver printed prices in the low 70s. In the real world, where metal actually changes hands, availability tightened and premiums expanded. When two markets for the same asset send opposite signals, one of them is lying. And it's never the market that requires delivery. Paper markets are flexible by design. Contracts can be rolled, settled in cash, or extinguished with accounting entries. Physical markets are not. Bars cannot be created to meet demand. When inventory's thin and buyers compete, price is supposed to rise. If it doesn't, something else is absorbing the pressure. That pressure was redirected into regulatory theater. Margin requirements were raised aggressively, pushing smaller participants out and reducing open exposure. This isn't done to protect traders, it's done to reduce risk when the system is fragile. Fewer participants mean fewer potential failures, and fewer failures mean less chance of contagion. What you were watching was not a market resetting itself, it was a system defending itself. The paper price was forced lower, not because demand vanished, but because stability required it. And stability in this context meant making sure a specific problem didn't spread beyond its point of origin. But here's the critical flaw. Suppressing a price doesn't eliminate the underlying imbalance, it only delays it. Physical demand doesn't disappear because a chart turns down, it waits. And when it returns, it does so with more urgency, not less. That's the risk embedded in what happened. The problem wasn't solved, it was postponed. Delaying a problem in financial markets doesn't reduce risk. It concentrates it. Once the year-end snapshot passed, the immediate threat was removed, but the underlying imbalance remained. The question shifted from whether the system could survive the moment to whether it could function without continued support. That's why the days after the event are more important than the event itself. One emergency action can be explained, repeated support cannot. If liquidity drains back out and price stabilizes on its own, the stress was contained. If not, the problem was never resolved, only deferred. This is why I watch infrastructure, not headlines. Open interest funding behavior and settlement pressure tell the truth. If open interest stays elevated after a violent move, positions still exist. They've been hidden, not closed, and hidden risk tends to resurface suddenly. Narratives quickly appear to normalize what happened. Technical explanations are assigned after the fact. That's not analysis, it's damage control. Price stories don't change physical conditions. Availability and delivery do. From what I'm seeing, the physical side has not relaxed. Dealers remain cautious. Spreads remain wide. That suggests pressure is still present beneath the surface. Liquidation fixed an accounting problem, not a supply problem. And supply problems resolve through price eventually and forcefully. This phase rewards patience. When markets depend on intervention to function, they are no longer stable. They are conditional. And conditional systems always face a moment when conditions can no longer be met. This is where positioning becomes more important than prediction. I'm not interested in guessing tomorrow's price or chasing intraday volatility. I'm interested in identifying whether the system is regaining balance or sliding deeper into dependence. For me, one level matters more than any other right now, 71. That price is no longer just a number. It's a line of credibility. If silver can hold above that level through the first real trading days of the year, it tells me the selling pressure was tactical, not structural. It suggests the forced liquidation accomplished its regulatory purpose and nothing more. In that scenario, underlying demand hasn't weakened. It's simply been temporarily restrained. And restrained demand tends to reassert itself quickly once the pressure is lifted. But if that level fails decisively, especially on expanding volume, the interpretation changes. A deeper move lower would imply that the liquidation was not just cosmetic. It would suggest a broader unwind, possibly involving multiple players reducing exposure simultaneously. That's not a market I want to engage with aggressively. That's a market still in triage. I'm also watching behavior, not just price. Does volume return after the drop, or does participation remain thin? Do bids step in confidently, or does every rally meet immediate resistance? Healthy markets invite engagement, fragile ones repel it. Right now, hesitation is the dominant emotion, and hesitation is never neutral. This is why I'm comfortable doing less, not more. Capital preservation matters more than activity during periods like this. If the system is still leaning on support, direction becomes less important than risk management. There will be opportunities later when price reflects reality instead of necessity. For now, I'm letting the market show its hand. Stability will reveal itself through consistency, not commentary. And inconsistency, especially when paired with continued intervention, is the clearest signal that the story isn't finished yet. Beyond price levels and volume, there is one mechanism that quietly confirms whether stress has truly passed or is still being concealed: liquidity facilities. Emergency funding is never meant to become routine, even though it is often described that way after the fact. The real signal isn't the announcement, it's what happens next. If the repo balances shrink quickly and disappear from the conversation, it means the system absorbed the shock and moved on. That's what resolution looks like, but If large sums continue to roll forward week after week, it tells you the problem wasn't solved. It was stabilized. And stabilization is not recovery, it's maintenance. This is why I pay close attention to repetition. A single intervention can be dismissed as coincidence. Multiple interventions form a pattern, and patterns reveal dependency. When institutions rely on continuous liquidity to function, markets stop reflecting supply and demand. They reflect survival priorities. There's also a psychological element here that's easy to underestimate. Traders sense when a market is being managed, participation drops, risk appetite shrinks, everyone waits for confirmation that it's safe to engage again, that waiting creates artificial calm, but calm driven by caution is fragile. It breaks quickly when tested. What makes silver especially dangerous in this context is its dual nature. It's both a monetary metal and an industrial input. When price signals are distorted, neither side can plan properly. Producers hesitate. Buyers stockpile. That tension builds quietly until it releases through repricing. This is why I don't expect resolution through commentary or reassurance. I expect it through action. Either the system proves it can stand on its own or it reveals continued dependence. And continued dependence always comes with a cost. Usually paid later and usually paid all at once. When markets reach this stage, clarity comes from watching what fails to happen as much as what does. If price remains suppressed while physical demand stays firm, the gap widens. And widening gaps create pressure that no narrative can relieve. That pressure builds silently until it reaches a point where maintaining the illusion costs more than abandoning it. This is where history becomes useful. Similar patterns have appeared before, not just in metals, but across asset classes. Temporary suppression, emergency liquidity, and confident explanations often precede a repricing event rather than prevent it. The longer control is maintained, the more abrupt the adjustment tends to be. Stability bought with intervention is borrowed time. Another signal I'm watching closely is participation. If fewer players are willing to provide liquidity, spreads widen and depth thins. That makes the market more sensitive, not less. Small orders move price more than they should. Volatility hides then returns suddenly. This is how controlled environments break, not through gradual change, but through abrupt failure. What matters most is trust. Markets function because participants believe prices are fair reflections of reality. When that belief erodes, behavior changes. Hoarding replaces trading. Waiting replaces risk-taking. And once trust is gone, it doesn't return easily. It has to be rebuilt through transparency, not force. I don't need to know the exact moment repricing occurs. I only need to recognize when conditions make it inevitable. Persistent premiums, repeated intervention, and declining participation are not signs of health. They are warnings, and markets are generous with warnings before they become unforgiving. At this stage, patience is not passive, it's strategic. Letting the system reveal whether it can function without assistance is the most valuable information available. Everything else is noise. What this ultimately comes down to is not a short-term price call, but a structural lesson about how modern markets really function. Screens can display any number they're told to display. Liquidity can be routed, delayed, or injected to meet regulatory needs. Balance sheets can be made to look clean for a moment in time. But none of that creates metal. None of it fixes shortages, and none of it changes physical reality. Institutions have proven they can manage paper prices when survival demands it. They can compress volatility, force liquidations, and control narratives long enough to pass inspections. But they cannot manufacture supply. When physical demand persists and availability tightens, price discovery doesn't disappear. It waits. The key lesson here is patience paired with awareness. Don't confuse intervention with resolution. Don't mistake silence for stability. Watch the infrastructure. Watch behavior. Watch what requires support to keep functioning. Those signals tell you far more than any headline ever will. Strategically, this environment rewards discipline. Protect capital when systems are conditional. Add exposure only when price behavior confirms stability rather than necessity. Structural mispricings are opportunities, but only when risk is understood and timing is respected. Most importantly, remember that markets always reconcile fiction with reality. The only uncertainty is how long that reconciliation takes and who is positioned to benefit when it happens. Physical constraints eventually assert themselves regardless of how sophisticated the financial overlay becomes. If this analysis helped you see the market differently, support the channel by liking the video, subscribing, and sharing it with someone who wants more than surface-level commentary. Leave a comment with your perspective or what you're watching next. That engagement is what allows this kind of independent analysis to continue. The new year has started and the real test for the system has just begun.